Well, what do you think?
We're here.
We made
We're
it
ready
past,
to go.
We made it past hump day. It's Thursday. We're ready to go.
We made it past tax day.
Oh, ooh, that was a humpy
Tuesday.
day.
So, yes. So, a
Tax
good
day.
week.
Yep. Kim is a little bit more relieved right now that most of the tax stuff is out of the way. And now she's just waiting for clients to get their returns back. So that's awesome.
Coffee bean futures are going down because Brenda's office probably won't be working 25 hours a day.
Oh, yeah, not drinking so much coffee. I see what you're saying. All right.
So,
well,
ready to get started?
I think we're ready. I think we're ready to go. I got my cappuccino. I'm ready. All right. We're going to start off with markets and the economy. I'm going to hit the performance first. So we're looking at the 2023 first quarter market performance in the main categories here. So the way this chart works, you've got Q1, which is on the left-hand side, and you've got year-to-date, which is on the right-hand side. And as you can imagine, being the first quarter, year-to-date, the numbers look the same. But let's go on. Looking at the U.S. equities, as you can see, U.S. equities really had a very nice first quarters, as well did international equities, being the leader, up 8.6%. Then you get into emerging markets equities, which had a little bit more of a struggle time at 4%, and then followed by U.S. bonds, international bonds, and emerging markets at 3%, 3.1%, and 2%, 2.1%. This was a bit of a choppy quarter. As you look at this chart right here, you've got the blue line, which is really the S&P 500, and then you've got the green line, which is the aggregate bond fund. And you can see it was a roller coaster ride all the way up to the end of the Q1. And it's still a bit choppy moving forward here from beginning of Q1 to where we are today, April 17th. So let's move on and look at where the indicators are. Most of us have seen the City National Rockdale economic and financial indicators. And these indicators are really 6 to 9 months looking forward. So the biggest changes we saw, one was U.S. economic outlook, which kind of had a little bit more of a damper on it and is moving over to the left. And you also had on the opposite side, international economic outlook, which went further into the red. And a lot of this has to do with the bottom left-hand chart right there, the dial, which is the credit demand availability. That moves solidly in the negative category. Now, you might say, well, darn, how did that happen? Well, the Federal Reserve is trying to slow down the economy. One of the best ways to slow down economy is choke the credit. And that's what's happening right now. As you can see in the news, you've got housing has slowed down. And one of the big reasons that has slowed down is because the interest rates on these loans are so much higher. And they've actually kind of tightened up the way they're going to allow these loans to go out, which makes it a little bit more difficult to get that. So the availability and the demand has gone down. And again, this is something that the Feds have been trying to do. They're trying to curb inflation. But you can see the inflation really hasn't gone in a positive direction. It's not moving right now. And the issue there is we still have supply issues. We certainly have labor. I mean, it's great that people are getting paid more, but the problem is that always translates down to the consumer. And the inflation is going to be running high on that for quite some time moving forward. And then you've got the equity market valuation, which has just been, it has been great and it hasn't been really bad, but ultimately what we're looking for there is to get the price earnings ratio in line. In other words, the price of the stock and the earnings on the company if we can bring those numbers down, it could be really a positive sign for investors jumping back into the market. They're looking for a bargain. The bargain's not there yet. Now, let's look at the overall picture. As you can see, at this point, we've got 7 red dials and the rest are yellow. There is no green in sight. And what we're really looking at here is the fact that the dials are just moving slightly, plus and minus every month, which means they really haven't picked up a clear direction on the way they're going. And what does that tell us? Well, it tells us we're not out of the woods yet. Now, when you think about recession outlook, looking at it from April's point of view, CNR has really looked at this very closely, and they're looking at all the indicators. But what we're finding is that there is a greater and greater chance that we're going to fall into recession. And what we're seeing here is on the right-hand side, you've got the outlook, probability, GDP growth, earnings growth. And then sliding down the left side, you can see we've got either an option of slow growth, mild recession, or normal recession. And what we're unfortunately seeing is that the recession odds raised to above consensus, which is over 75%. Which means it is very, very likely we're going to fall into a recession from a technical standpoint. Now, looking at the GDP, if we do fall into a mild recession, you can see there'd be 0 to maybe a -1 growth as we move forward. And earnings growth, that wouldn't look too good either. We'd be at -10 to 0. And quite frankly, that's not a positive sign for people wanting to jump into the market. The mild recession is the most likely outcome here, so that's what I'm focusing on. But it isn't looking any better. So it looks like we're going to keep moving forward at this point, Rocky, towards that recessionary period.
Yeah. It was interesting to see the chart from year to date into April of the S&P, how it actually literally went up to about 8%, and it almost came all the way back down to 0 growth in the market, and now it's back up to 8. So that's a lot of volatility.
Yeah,
and there's signs that rollover may be happening again going into the summer. And hopefully that's one of the last times we see kind of that downward rollover, stabilize, and maybe get some footing moving forward.
That would be a very nice thing if we can get to that point.
Yeah, a lot of variables though.
Well, there are. And we don't know what kind of shoes are going to fall in between either.
Right.
But we're watching.
Yep. So what I want to talk a little bit about is the renewed interest in the bond yields. For the first time in about the last 15 years, actually, investment grade yield to worst has become attractive again as part of the fixed income portfolio. So we haven't talked a long time about really getting heavily involved back in the bond market, but we've seen signs at the beginning of this year that things are moving, finally turning around. Remember, last year was one of the worst years in 40 years for the bond market. We're starting to see that stabilize. And as you can see in this chart, that investment grade has actually entered the green area, which makes it, as far as CNR is concerned, attractive range to start getting back into the investment grade corporate bond world. And I just want to explain something here. What yield to worst means is that most of the bonds out there have an ability for them to be called early. So if you looked at the fact that the bond could be called before the maturity date, that in essence means you'll make less interest on it over time because it got called early. But if we look at what the worst case is for that bond, that's what the yield to worst stands for. So the worst case, if you're getting into bonds right now on most of these investment grade corporates, they're over 5% yield to the worst that they can do. So if you hold them to maturity, they do great. They'll do better than the 5%, but if they get called early, the worst you're going to do is about 5%, which hasn't been around for a long time. As you can see, the yellow line is way below the green bar representing the range you want to be buying into this yield. And as also you can see on this chart, the blue line represents the high yield market. And there's about a 3 to 3.5% gap in expected yield. But again, these are high risk, very volatile, more volatile than your investment grade bonds. So you would expect to get a premium on taking that risk. And that's primarily where the market has been in the past few years, because corporate bonds and investment grade bonds have been so low on a return that you had to take on more risk to get that return, as you can see in this
Well,
chart.
you know what I find interesting when you look at that chart there is going back to really when they were calling the secular bear market for bonds. You can see the mini bears and the mini bulls that are going on
Yep.
within there relative to the yield. And it's no wonder people are like, wow, do I get in bonds? Do I get out of bonds? It's a tough situation for bonds.
Yep.
But you're right. This could be a good time for, matter of fact, it is in many cases. And it's not just corporate bonds we're talking about. We're talking about treasuries, anything that's more investment grade on the bond part.
Yeah. So when you're looking at investment grade, you can see that higher yields in the investment grade have opened the door to a more diversified fixed income allocation that's being brought back into the portfolio now with these higher yields. You can see, based on the types of fixed income asset classes too, which are the highest risk for default based on their expected returns. I mean, look at structured credit. There's a lot of default that happens normally in that sector. So when you're trying to get that extra yield, you're taking quite a bit of risk, and especially when you're going towards potentially a recession. So that's why these numbers are going up, to get people to invest in these higher risk assets on the fixed income side. It's got to give you a better return.
Well, not only that, you better be diversified, right?
Yep, and that's what the fixed income managers do, is they take a mix of this. They take all these different sectors and come up with a good blend that can actually give you a higher than average rate of return moving forward. So they wouldn't buy just one of these sectors, they would buy all of them and apportion it based off of the amount of risk and return they want out of that portfolio. Now let's talk about applying a fixed income allocation to the portfolio and how it's dependent on how we see the economy moving forward. The green represents, as Dan showed earlier on the recession slide, that represents maybe slower growth, but it's stable, and high yield can remain attractive because default rates are relatively low when the economy is stable. But as you move into the yellow, where we could be entering a mild recession, yellow represents potential negative growth and the need to be cautious and to start moving out of those high yield bonds into safer type of investments. And then obviously the red, when the recession is looming, there tends to be a flight to safety. And that's what you would see here, is where high yield bonds just would not be a part of our portfolio. And we would only be looking for the highest quality treasuries and corporate bonds to kind of stabilize the portfolio moving forward.
That's a pretty good chart. I mean, that really kind of gives you an understanding of where the issues are when you're in a recession and what to stay away from.
Yep.
So I like that. That's a lot of good information right there.
I just think it's interesting that we're finally able to talk more about a true asset allocation. I know a lot of people are familiar with a 60-40. They've heard that term before, 60% stock, 40% bond, which kind of gives you a balance. When stocks are up, generally bonds may be down a little bit, but when stocks fall, bonds tend to come up. Well, now that there's a yield available on the fixed income side, we can go back to looking at some of those balanced portfolios and expecting to get some type of return over a long market cycle of ups and downs. So
it's kind of interesting, because if the price of bonds are high and you buy into them, and the bond price goes down, the yield obviously goes up, but that doesn't really help you a whole lot, does it? Because you've lost the asset. But we're kind of flipped on that right now, to where the prices are actually pretty decent and the yield's high. So that's why that yield to worst looks better and better
Right.
as we move
The
forward.
bonds have been so discounted because of last year, they actually are a good buy looking forward.
Absolutely.
Buy them at a discount.
Okay, let's go ahead and move forward then. So what are we watching moving forward here? This chart here kind of gives you a graphic of the expectations and some of the key signals that we're looking for as we're making strategic moves within the portfolios. On the left-hand side, you've got the indicator. You've got economic activity, whether it's bottoming or not. You've got upward earnings revisions. When they start, that's always a good sign. And then the high yield spread peak is another one. So when you look at this chart, it really kind of projects out the rest of the year here, April through December. And from an economic activity bottoming, we're really looking at somewhere between July and November. Now, does that mean we've hit the bottom of the recession and we're on the way out? Not necessarily. And we'll talk about that in future webinars here. But it is an area that we're looking at, and we're actually looking for the bottoming activity to give us those signals as to when to go back in all equity of the market. You look at upward earnings revisions. Now, when does an investor like to get into stocks? Well, when stocks are low, but yet the earnings are looking better and better and better. So that's when you start getting the big money going back in, and that's looking closer to November, December. Then you got the high yield spread peak. When that hits, it's a pretty solid indicator that we're getting ready for the market to turn around. Now, let's move forward here. So when you're looking at the potential next steps for the portfolios and talking with the different money managers, the institutional money managers, this is what we're seeing out there. And again, I want to thank City National Rockdale because they put a lot of great information together for us to be able to illustrate to our clients. On the left-hand chart, you've got asset allocation positioning, you got stocks and bonds. So under the asset allocation positioning, you've got the current, which is where we are today, a base case, which is right now looking more neutral, best case scenario, worst case. And how does that apply to where you want to be within the stocks and the bonds? So let's talk about that. Let's go to base case first. When you have signs of bottoming in the economic activity, that is a good sign right there, but it's the beginning of a new growth cycle. And when you're talking about a beginning of a new growth cycle, what do you need to do? Well, in this case, you want to add cyclical U.S. equity exposure because that's a strong case at that point. Then you want to reduce the investment grade fixed income. Why is that? Well, because as everything starts shifting more to U.S. equities, where does it come from? It comes from fixed income. So that would be the base case there where you have a neutral weight on both sides. If you look at the best case, now let's look at it from a higher confidence of a multi-year expansion and the geopolitical risk is easing. In other words, if the war ended, how do you decide to invest from a global standpoint? Well, when you're looking at this in a best case, the U.S. tends to be a very strong market and tends to pull out sooner. So we'd be overweighting U.S. equity exposure and underweight fixed income at that point. And from an international equity, again, if everything is settled down, well, I think it's a good time to get into international equity under those circumstances. But if tensions go higher, then, well, we might want to be very selective as to where we go from an international equity standpoint. Now, let's look at the worst case. High risk of structural bear market, deeper recession, and, man, some major shocks that could hit the system. In that scenario, where would we be? Well, we would reduce the equity exposure, just like we have over time here. And we'd increase the allocation in the investment grade fixed income, again, like we have done so far. So it's interesting. It kind of lays out the asset allocation positioning that the money managers are looking at as they work to manage that portfolio, to minimize the downside and really maximize the growth when the markets turn around. So let's recap this. First of all, the S&P index is up, the first quarter 8% year to date, and it's kind of hovering around there right now. Second, the economy is slowing, but inflation remains high, above the Fed's desired rate of 2%. It's not likely we're going to get down to 2% anytime soon. Next, we're going to look at increasing risk for a mild recession in the second half. Now, we've talked about that. The risk is even higher at this point, so the second half is the likely target date that they'll call the mild recession. And then economic activity is expected to bottom in the second half. It could very well be closer to the end of the second half, though. Looking at 1 to 5 year investment grade bond yields, well, again, they've become more attractive. And then finally, portfolio equity allocations will still remain defensive until things start looking up from an economic and financial standpoint. So there we are.
You know, it's interesting when we look back to when we were doing these webinars last year, we talked about going from equities to cash because you couldn't go to bonds because they were going down like the equities. This year's scenario is a little different.
Yeah.
Now that we've got some yield out there to work with in the fixed income market, it makes sense not to go to cash,
absolutely,
but to go into the bonds and hold those as your stabilizer.
Yeah, and as
until the economy turns around.
Right, and as most of you know, we're working with really shorter term, shorter duration treasuries in a ladder type portfolio, or Fidelity has got a pretty good rate on their money market for anybody who has $100,000 or more. So you're looking at 4.5+% for there. So it's easy to get in, easy to get back out again when we need to.
Right.
So yeah, we've got the solutions, and at the end of the day, you know, we're ready for what you need to do, right? To get ourselves in play and make sure that you're taken care of. So keep in mind that we're a full wealth management firm, so it's not just investment consulting. You know, that's a big part of it, and it's a driver for all the other advanced planning that we do. There's really no need to worry. You take care of your family, and
we'll take care of you. We're ready for the future.